Hello, YouTube. The correction is here with most ETFs and major stocks now actually hitting a big corrective move. Here we're looking at equal weight S&P versus S&P. We can note that on the left-hand side, we know we go from the 50 to the 200, and then we go even lower. Well, on the right-hand side, as we undo the pattern and now show it to you again, we note that we get a crash roughly to our uptrend and almost to the 200. Here for S&P, that would mean about 400. And then we get our second leg lower and volume comes in. So for S&P to have the same thing, I'd be looking for volume to come in and for us to get a big flush in volume. Another way to look at the same pattern is, again, RSP on the left-hand side and S&P on the right-hand side. What do we note? A first corrective wave that tests the 200 DMA. Same thing happening here with SPY, which is where we're now below it. And then we get that second flush lower, which means that's where the S&P goes below 400. And one more pattern, RSP or equal weight, is now closing below its 50 monthly moving average. And with Tuesday being the close of the month, this is like really important. And now, as we just noted, we also have that close below the 50 moving average. And nothing good happens below the 50 average. As we noted here on the daily chart, once it happens, it's usually not good. And then future hindsight can show us here that we have a death cross, which means that momentum is now lagging. We're actually getting momentum to the downside. All right, so we got a big show for you today. Extreme fear is back. Last weekend, we talked about how the stage was set for a big move to come and how to prepare. Well, it looks like the correction's here. Everything's red. We had earnings from big tech. Microsoft is basically flat, even though it was a crush earnings. Amazon is flat, even though it was a crush earnings. Otherwise, everything's red. Nowhere to hide. Which means there's pretty much a dumpster fire right now. And when the title says the correction is here, what I'm talking about is most stocks and ETFs are now down by more than 10%. Microsoft 10%, Germany 10%, the Dow 12, S&P 14, healthcare 14, Apple 15, the Nasdaq 16, equal weight S&P almost into bear market territory. 20% is bear market. NVIDIA almost in bear market, Google almost in bear market, Meta in bear market, XLF bear, Amazon -32, the Russell -34, emerging markets -37, Tesla half, -50, Bitcoin -50, FXI or China -53, and then Ether -63. Whoa, are we actually still in bear market? Here's another conflicting data point. It tells us that the speculators actually went net long, right? They don't often do that. They short double down, then they go net long. Is this actually the bottom? Man, we got so much news to go through. Please make sure you stay tuned till the end because there's weekends where I feel confident. There's other weekends where I don't feel confident. So like when we talk about that, right, big move coming, well, the big move is starting. And if it's going to continue, closing out the monthly chart is going to be fairly easy for us to track. Something I don't really like as a bull this week is that 53% of people think we're going to go higher. I don't love that, to be honest. I don't like when people from retail are betting with the crowd. And we also have the big man talking this week. So a lot of mixed data. We're going to go through and try to make our best effort to prepare you. And I'm putting a lot of effort into this weekend's video. So if you wouldn't mind, please considering to smash that thumbs up. Let me just see if I can find it here. I would really appreciate if you could please consider subscribing to the channel or smashing that thumbs up. I would really, really appreciate it. And I'll thank you ahead of time because you guys have been so good. I put a lot of effort into this video. So we're going to talk about Jerome. We're going to go through and look at the economic data. Notably, we got non-farm payroll coming out on Friday. And the number looks cautiously optimistic, where we're going to have under 200,000 payroll jobs, but the unemployment rate is sticky at 3.8. The Federal Reserve, including Jerome, is going to talk on Wednesday, and we're going to hear about interest rates. Bank of Canada paused, ECB paused. The Fed is likely going to pause again. We're also going to talk about earnings with the big dog, Apple, or the largest stock coming in on Thursday. And that'll be important because, oh my goodness, has that heat map been red so far this week? We also see that we have basically a strike tentative agreement here for the United Auto Workers. So that just means that, hey, that's a positive headline, but hey, we got our doom right here. We'll come back and look at this one in a moment. But Netanyahu says the second stage is starting. Oh my goodness. I'm sorry that we did not expect for this to surface up. This is not good. We're going to go through the headlines in a second here, just previewing that. And then we also have Jerome to go through where he's telling us that inflation is still too high and we have to lower economic growth, likely for that to start. And then we see that we just got a preliminary print for Q4, which is coming in at 2.2%. Is that going to be that happy medium for Jerome to pause? Maybe even, God forbid, provide some guidance to tell us what's going to happen into the future? Everyone keeps talking about he's driving on a foggy night. Man, it seems like I don't think he understands the wheels are falling off the bus. So if we're worried about fog, that's one thing. If we're worried about landing, soft landing, hard landing, well, that assumes the driver's in control. I don't know that the Fed is still in control, and I'm going to go through the reasons why in a moment. So if the tires come off the bus or off the plane, if you try to land, it's not going to work. You're not going to come to a stop. Things are going to get out of control, where now your narrative is doing you harm. And we're going to go through all that because there's some stats we're going to look at. I'll tease that out in a moment. But then we're also going to talk about Apple, where Apple reports, and we have the earnings whisper here at 145, which would be a beat coming out after the bell on Thursday, which is after Jerome. But what I'm not as sure about is what their guidance is going to be. So the guidance matters because right now, when we look at we can look at current PE, which means what stocks are priced at today. There's a lot of red. We have a little guide over here. Closer to 30 means overpriced. 15 is good. Below 15 is better, right? That means we're cheap. So what's cheap right now? Well, not a lot. But when we look at the forward PE, well, Tesla's actually only 50, right? Where's Nvidia? You don't even see it at 24. Whoa, that's like pretty affordable. Amazon 36, cool. Microsoft 25, Apple 25. Things look a lot less expensive. So this correction is either over, or man, it's either 1987, 2008, and all these extra gains in the last 12 months are going to get wiped out. So that's it. Let's go through each one of these one by one here now. So at a high level, we talked about what Jerome's going to do. We're going to talk about these numbers now. So inflation out of Europe, that looks really important. From 4 down to 3. Man, that's getting pretty close to 2, right? That looks constructive. Consumer confidence coming down to 100. That's also good because it means that retail sales are likely going to be a little bit more in line, and maybe people are going to spend less, which would mean less inflation. Like we mentioned, we also had the Bank of Canada and the ECB come in with their rate decision already. So I think the Fed is likely going to pause. The question would be whether or not we get guidance. And we'll talk about that a little bit later when we get to Jerome. BOE rate decision, again, expecting a pause. Initial jobless claims will be important, but this one here will be more important. It's the non-farm payroll and unemployment rate coming out on Friday, pre-market at 8:30. So like I mentioned, if this would have ticked higher, people lose their jobs, more people lose them. The Fed would like that, but we already know they're going to pause. So I don't think that this is really going to move the needle. But this right here, the non-farm payroll, and I'm pretty sure we get the ADP one. Yeah, we do get it on Wednesday. We'll see what happens. ADP has not been reliable at all. So let's watch it, but let's pay attention to Friday, because coming in below 200,000 is constructive. But the part that I don't like is average hourly earnings are now going to be going from 0.2 to 0.3. That's not going in the direction we want. So there's some good and there's some bads, and these are still forecasts. So let's keep that in mind. And then we'll come back and talk about Apple, like I said. So United Auto Workers is good. That could explain part of the average hourly earnings going higher, but not all of it, right? Let's be honest. So the concern here would be a wage price spiral. So key dates for the week are going to be Tuesday, Monday, right? The reaction to what's going to happen here. Still not sure. And then we're going to go through and talk about consumer confidence on Tuesday with European CPI. Jerome is really important on Wednesday and then Friday. There we go. So the big man, and people think we're going to go up. So maybe we go down to start the week off, and then we go up to finish the week off, right? That would be equally painful for both teams. And why does that also matter? Well, it matters because we're closing out the month on Tuesday. So the month closes out on Tuesday. Jerome talks on Wednesday. And then on Thursday, we got Apple. Man, it's going to be a busy week. What's so interesting to me is that the speculators are actually net long for the first time ever since the Fed hiking cycle began. And it's no surprise Jerome talks tomorrow. This is like a really good clue. They're shorting into the low of the week, which is odd, which means they probably think we're going to go higher. So was that enough? Is the dumpster fire done? Are we now finally going to go up? Because like a lot of these things are on heavy discount. We can look at some specific charts here really briefly to see exactly what's happening with one versus another. Let's go back here because I'll show you the pattern that I've been looking for. The pattern I've been looking for on SPY happened on Bitcoin, ironically. So I shared a whole bunch of these. I shared actually probably like 30, 50 charts on Twitter or X. If you want to go follow me, there's my handle, link in the description. And what's important here about Bitcoin is that it's still above its 27 high or previous excitement. It's 50% off the highs almost exactly. And here's the pattern that I've been talking about. I actually found it. So we have our failed breakdown, which is a bottoming pattern. But then we also have, so here's the bottoming pattern. We have that failed breakdown. We get over the 50 MA. And then once we print a a new candle high, man, we go up a lot. We're up 26.7% on the month. Booms, right? Big booms for Bitcoin. And the fact that Bitcoin is booming, man, that tells me something very strong. Gold at 2,000 with a bullish engulfing monthly candle, and it's set for a closing record high. Something is funky here. Why? Bitcoin is up by 27%. Gold is up by 8%. Bullish engulfing monthly candle, record close. What else is up? I think the dollar's up. The dollar's up by 0.4, and it's flirting with areas that we don't have going all the way back to the 1970s and the 1980s. And like I mentioned, when we go to this part here about Jerome, we're going to talk about this stuff. Look, pause the video. 1980s, 2000, now. Whoa, that seems like we're kind of like spending too much money. That's going to be important for us to talk about. It will. All right, something else we want to look at here. So Bitcoin up massively on the month. Gold up massively on the month. Record highs. Okay, dollar up. Back to areas we haven't seen since like a long time ago, like before I was born. Then we look at the VIX, green on the month by 21%. Only at 20 though, still below the averages. But this is like not good if you're bull. But what's down? Almost everything else. One more thing I want to point out is just I want to point out the inversion as well, because when I look here to the inversion, these are all monthly charts, by the way. We're focusing on monthly and weekly charts this week because very high timeframes are what's important here. And like I mentioned, I shared a lot of these things on Twitter or X. If you want to go follow me, that's my handle. And I would really appreciate it if you could please just consider subscribing to the channel. Thank you so much ahead of time. So when we invert and then uninvert, that usually means bad things are happening, right? Here it happened in 2000, 2001, 2007, 2008, and then 2020, 1919, and 2020. Oh my goodness. These are like all bad times, big market crashes. And a lot of stocks are already crashing. RSP, 30% off the, 19% off the high, flirting with bear market territory. Whoa. Okay. So why now we're going to keep telling the story here. Let's look at a couple more quick charts because it's also important to understand that even though Tesla is still overpriced, the chart here on the monthly is not good at all. But other stocks do look good. Like Microsoft looks like a cup and handle here, right? New all-time highs. It looks like XLK instead of QQQ. So depending on how you slice the data, if we look at QQQ, you're like, oh, well, it didn't make a new high and it's stopping to go up. And I would agree with you. But we have to understand what is inside of QQQ because the weighting is a lot less Microsoft and Apple versus when we look at here at something like an XLK where this one looks a lot better. It doesn't look fantastic, but what I prefer is that we made a new high because Microsoft and Apple did. It looks more like a cup and handle. And we technically have a low, lower, lowest, but we're actually still above the September low, 160.61, which implies that Apple is actually still technically, as of this moment, this recording, in a failed breakdown on the monthly. Man, I thought Apple was like a lot lower. But I think that's because if we look here to one more second, if we pull here to the heat map, if we look here back to, because if you've been an Apple investor, like you're like, well, it hasn't really been all that great. Why? Well, Apple's, again, only up 13 in the last 12 months. When Nvidia's up 197, Microsoft up 42, even with Google's massive decline in the last 12 months, it's up 30, Meta 200, Amazon 12. So Amazon and Apple are not the A team right now. They're lagging. So depending on what chart you look at, things look a little bit different. Like Amazon, not currently actually above, it's above 2018 highs, but it's below 2020 highs. That's not good. Think about Amazon had to ramp up spending going into the lockdowns. And now they're trying to improve their numbers. It's technically below the 50 monthly, and it's also below the 200 weekly. There is a cup and handle, but like there's a lot of competing patterns right now. So what I tried to do is to go through all the data to try to tell a more synthesized story, but this video will be longer. Why? Because I'm also going to walk you through my thought process in terms of how I put my thoughts together. I'm not just telling you exactly what I think. I'm showing you part of the recipe which goes into my thinking because like I mentioned before, there's times I feel very confident and there's times I feel less confident. I don't feel very confident right now in terms of where we should go because I'm seeing a lot of conflicting data. And frankly, when things like this happen, I don't feel like I have an understanding of this. I'm not a military strategist. I don't know what this means, second stage. Man, I thought measles in the sky. It was time to buy. Well, the short sellers are buying, the speculators are out, but woof, right? This could escalate. When I read this headline, my butthole percolates a little bit, right? It gets tight. Second stage is starting. This just got announced recently. But last night, Iran warns of new fronts against the US if Hamas war continues. Well, they literally just told us, right? We're escalating and we're not planning to stop. Here we go. And updated again. Warns of what? Oh my goodness, right? Long war as invasion begins. Oh my goodness. As it just begins, he's like, well, warns of new fronts. And he was in New York, I believe, or in the UK doing an interview with Bloomberg. And this is not good because, as we just mentioned, they're now expanding their operation after an aerial blitz. And also, the US strikes Syria base used by Iran linked groups. This is from yesterday. Whoa, it seems like things are escalating pretty fast. Yes, they are. And this is not good if we're trying to make money investing because, man, we could get a nasty, nasty shock or a nasty surprise. If we look here to VIX, we're going to look at two charts really fast because this is the volatility index. We look here to the weekly chart. And what it shows us is that we're back above the 50. We're battling for the 200 after tagging it. But the important part is that if we stop going down, man, we could get a massive bout of volatility, which would mean that stocks are probably going to get a massive plunge down. And look what happened in 2020, just like the uninversion. We just talked about it. 2020, 2018, 2016, and 2008, and then 2000, right? Oh, no. Yeah, that's what happened. So, like, I'm very aware of it. The trend or team probability is still that we keep going lower. But at some point, the risk reward does not justify the trade anymore. And then on the monthly chart, we're also at risk of breaking out here. So we're at risk of breaking out. And I'll show a couple more quick charts because I think it's important. Let's look and see what's above the averages here. What's the dollar at? It's above all averages. It's above the black line, which is the long-term price. On the right-hand side, we have the monthly. Left-hand side, we have the weekly golden cross. The arrow is pointing to the golden cross. We're above all averages. That's not good. If we look here to the 2-year note, we're currently above everything too, pointing up, golden crosses. Whoa, this is not good. Right. All right. What else have we got here? We got the 10-year note also up. All right. So these ones here already have golden crosses, golden cross in the making here. It's going to happen pretty fast. Whoa. Right. Yeah. Things are getting pretty extreme here. And I have not been trading for decades, which means that I've seen corrections before. I've seen some, but what I'm really thinking here is whether or not these stocks are going to drag lower, like meaning the stocks that are only down between 10 and 20, which is Microsoft, the Germany, the Dow, S&P, healthcare, Apple, the NASDAQ, equal weight S&P, NVIDIA, and Google are going to join the bear market crew. And the bear market crew includes Facebook, financials, Amazon, the Russell, emerging markets, Tesla, Bitcoin, China, and Ether. Or if these ones, which are in bear market, are now going to flip and be less than 20% off the bottom. Technically, we birth a bull when we're 20% off the bottom. But I'm just trying to look at what is currently now technically in correction. It's everything. Big cap, small cap, emerging markets, developed markets, doesn't matter. Everything. And which team's going to go flip, right? Of course, I'm going to talk about flipping because I'm a flip, flop, and flapjack, and I flip all the time. So there you go. Are the bears going to flip to less bear, or are the corrections going to flip to bear market? All right, so let's keep the story going here. Extreme fear. Well, normally we buy extreme fear, but extreme fear can last for a while too. It's not like you guarantee things are going to have to just shake out. Why? This is a black swan potential. So if we think about this, just read this and ask yourself whether or not this sounds like, oh my goodness, is there peace coming? Measles in the sky, it's time to buy, usually means peace is right around the corner. Well, that doesn't seem like it's anytime soon, right around the corner, right? Call me crazy. And now this country and this country are having issues after what that guy just said. Look at this right here. This is happening in London, right? Absolute massive protests happening as people stand with Palestine. I'm not telling you who to agree or not agree with. I'm just telling you that geopolitical tension seems to be really rising. And these are times when I don't know, right? I'm not a military strategist. I don't know what's happening, but I can look at this and say the charts are giving me a story. And when in doubt, zoom out. And as I zoom out, the story for me is getting very obvious. There's clearly a lot of tension. This is a large amount of people, and if we look across the world too, there's also a big protest here happening in India. um, where you can see this is just a huge amount of people. It's so many. So what is this going to lead to? I'm not sure yet, right? It's only Saturday, and these headlines are crossing fast. So all I'm trying to be mindful of is like, what are the charts telling me? And again, we will go through a lot of those a little bit later in the show. But what's most important to me is that as we're looking at these charts, and I'm trying to understand whether or not the odds or the probability have some kind of catalyst which could break the pattern. Right now, volatility is nowhere. 20 is low. Below 20 means the market is calm, cool, collected. Nothing is expected that bad to happen, but we're already in correction territory. So something doesn't add up here. I think it's because people have been conditioned to buy the dip, and because we've had all these bouts of volatility over and over and over ever since 2020. How many times do we get above 30? It's a lot. But the volatility always decreases because the amount of times you can have a black swan that truly surprises you, right? Financial crisis, banking crisis, what's happening in Eastern Europe, what's happening in the Middle East, supply shock, food shock, everything, right? People are tired, they're fatigued. So look at how many times we get above 30 here. Let's make it. I'm actually curious on this. So let's go to 30. Let's stamp a line there. How many times do we get above? One. And I'm looking at, we go over 30. And then if we count it again, it means we have to go back below, then back above. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 times there's been an actual shock, right? An event, all right? When everyone keeps talking about, phew, there's an event coming, the financial accident. Well, there's been 14 potential accidents. There's only been one massive one, which was the lockdown. But otherwise, right now, people are not pricing in any kind of risk. But if we break out, oh boy, it happens fast. VIX from 20 to 80, that's a 400% increase on one candle, 1 month. It can be a one and done, goes all the way up, all the way back down. But it just doesn't have to be. And with the headlines that are currently crossing, we can start to try to predict what's going to happen. Those ones that I read to you, I don't like them. I hope peace happens. I don't think that now's the time to be getting overly political. This is a stock market channel. We're here to try to make money. So with that said, it's not that I don't think there's anything bad happening there. I'm trying to think about how this can move the markets based on what is priced in versus what could be priced in. We've talked about forced selling before, and Wednesday is going to mean whether or not we're going to get more downside. As a reminder, let's go to the chart we've just looked at. It's the weekly chart of equal weight S&P 500 versus the S&P 500. On the left, we have RSP. On the right, we have S&P. If we look at where we are in the pattern, it implies there's a shakeout that happens around the uptrend. Where's the uptrend for us? At 400, right? Nice big round number. I would expect at least a dead cat bounce there. But then we get the second wave lower, and then we slam to the 200. For us, that's below. That's below. On the daily chart, it would also mean that we're repeating the pattern. It looks very similar. When they say history does not repeat itself, but it often rhymes, man, the high time frame charts align, but the daily chart here shows us the same thing. Lose the 50, dead cat bounce off the 50. Go to the 200. So bounce. Get to the 200, get to the 50, lose the 200. You probably see it there. Oops. If we now go forward, we see that same thing. So 50, 200, 250 below the 200. Then we get a second wave lower, and then the death cross happens. So for us, that would lead to us being a lot lower than where we are right now, and that would likely mean that we're going to be getting a test on the high time frame for S&P, which would mean probably our 386 or 50 monthly moving average. So if that same thing happens on RSP like we did on SPY, well, RSP is already testing its 50 monthly, and it's currently below it. There's 2 sessions left to close a month, though, with a lot of really bad headlines going into the weekend. Oh, no. So that's the first half of the week. What happens into the second half of the week? Well, let's read the headlines here. And I'm just going to tell you how I am interpreting it, and then I'll tell you the action based on what we've learned at the end of the video when we look at the charts to round this out. And again, thank you very much for tuning in. I really appreciate your support. And if you want to join me to trade with me, you can look at the link in the description, or you can go to thealgo.com. But I just really want to try to help this weekend. If you want to come and trade and support me, you can do that by getting a 14-day free trial, but we'll talk about that at the end. Powell says inflation is still too high and lower economic growth is likely needed to bring it down. Let's see if we can understand what he's talking about. Last quarter, we had, this is from GDP Now. It actually got reported, I think, at 4.9. So we got Q3 GDP for the US, and we can look here at the, let me see if I can jump over to it. Let me go to GDP now. These are not the official figures. It's from the Fed. But anyways, we go from 1 to 2 to 5.4. That's high, right? Because that creates inflation. And half of this was from government spending, right? They call that the fiscal side. So when the government's spending in Inflation Reduction Act and all this other all this other good jazz that they're spending on, well, that created and like restocking the war machine, all that stuff, that created about half of the inflation here. Sorry, half of the GDP. So 2.4 to 5.4 down to 2.2. Well, we're probably closer to 2 if the government stops spending, but they're not going to stop spending. That's part of the reason why the debt ceiling happened and the House Speaker got thrown out. So if we go back to here, what Jerome is telling us, right? Let's just read the headline and see if the data supports it. Powell says inflation is still too high and lower economic, that's the first part, still too high. Yep, I understand that part. Lower economic growth is likely needed to bring it down. Okay. Well, now we're getting a preliminary reading for Q3, and Q3 right here, you can see updated as of, it says today, but I'm assuming that's on the October 27th. So that was updated yesterday at 3:06 Central Time, and that was 2.2%. Well, that's good. That's less than half from before. So is likely needed to bring it down. So if he's seeing the data that supports what he wants, literally, explicitly, without a recession, man, this guy looks so smart and so cool and so sexy, right? He did the soft landing. Everybody sees it. But the part that I don't think he actually appreciates is that we're not in the same financial position as we were in the 1980s or the 2000s or now. When we're looking at the dollar, we're looking at yields, we're looking at gold, we're looking at all these things. Man, it does not look good. Look over here to the Fred chart. We'll look at this one a little bit more closely, but all I'm trying to show you here is that think of it like your credit card is maxed out. So your credit card is now maxed out. For every dollar you let's see if I can zoom in a little bit closer. Because this image is really simple, but it's also really important. So when we look here to over 100% means that every $1 you make in salary. So pretend you make $10,000 in salary. Well, you owe $3,400 if it's 34%. So your credit card, you make $10,000 a year. You currently owe $3,400 to Visa. In the 2000s, you have that same salary, $10,000. Now you have $5,500 on your Visa. But now today, in the 2020s, you make $10,000, but now you owe Visa $12,400. Whoa. Well, that's like 3 times more than the 1980s and twice as much as in the 2000s. So, okay. So our Visa's racked up, and now it's a matter of the interest rate. So the interest rate is as high as we were in the 2000s. But look back here, 1990s recession, 1980s recession. So they jack up interest rates, and then something breaks, and we get a recession. Well, that doesn't seem like a big recession here. That's the 2021, right? Well, whoa. Okay, well, 2008 didn't look fun. 2000 doesn't look fun. And they call these shallow recessions, by the way. Right? That's the Great Recession in 2008. 2000 was a shallow recession, but tell stonks that. They went down by half. We already talked about a lot of stocks being down significantly. We went through that list of stocks that were down, like FXI already down by half, Bitcoin half, Tesla half. Well, man, that could be S&P joining the party there. So if something broke, right, in 2000s when we had half of the debt now, in the 1980s, right, interest rate was higher, right? But it's not like egregiously higher. It's twice as high as it is now. But like the word dips down to roughly 6 or 7, and that's notable. So when the Fed says, right, it's a foggy night. Here, I'll draw a couple things on the chart here because this is what I keep hearing: soft landing, hard landing. Man, do we even know that the car's been serviced lately? So we're flying on an airplane and we're expecting that. Here's our landing strip. And Jerome's like, oh, yeah, soft landing, going to come in nice and cool. And when you're on an airplane, right? Land slowly, soft land, right? That's your landing strip. Well, what happens if you soft land, but the wheels don't come down? Well, you don't land softly. So your trajectory could be good, but when you land, it's not going to be so fun. And that's what I think people don't understand. I've heard Jerome talk about it's a foggy night. We have to be cautious as we poke around and find out what's happening. But like, did you bother to go to the gas station to get your wheels checked, check the tire pressure, make sure you can actually drive? The driver's cool, but if the wheels are coming off the bus, it doesn't really matter what the bus is doing. Without wheels, it's not a fun ride, even if there's a driver inside of here, right, Jerome? And you can probably appreciate my drawing. So if you do, please consider smashing that thumbs up or subscribing to the channel. Thank you so much ahead of time. And I'm trying to tell little analogies to maybe something will click for you, because what I want you to know is that I don't have all the answers, but I'm trying to think about what does Jerome know? Does Jerome maybe have a knowledge gap or maybe a bias, or he's trying to say things instead of what he actually believes? Hey, I make mistakes too. I'm sure Jerome's going to make a boo-boo. Right? He said transitory for too long. Maybe he's going to be higher for longer for too long, right? They're usually early everywhere. So if now we think a little bit more about the Fed, and here we have a 2023 meeting calendar, what's really important are the meetings to have the asterisk beside it, which means this is a meeting with an SEP, a summary of economic projections. So right now, Jerome has been bad. He's been forecasting, and the numbers are not coming in good, meaning where he projected them. So he's flip-flopping too. If you look at his unemployment rate, his GDP numbers, man, he's flipping. So we can look right here to, where's the projections? Let's just do it. Since this is going to be a longer video anyway, let's just do it exactly the way that I want to do it. Let's go here back. Let's look at the PDF because I want to see the projection models. And now we'll just do this really, really fast because even the best banker in the world, I'm sure a lot of people think Jerome's a good banker. I agree with him. Does he know everything? Probably not. And he's been flipping, flopping, and flapping, right? Flip, flop, flap, all that good stuff. Let's look here and see what I'm talking about. Why? Because, man, it's hard to know what's going on right now. So if we look at the revisions, we can look right here. So hopefully you can read it. The June, so the lower number, we always get a June projection every time there's a lower number. And that means this is as of September or the last time they had an SEP. So here in September, there's an SEP. And then in June, there's an SEP. The next time we get one's going to be in December, October, there is none. Which October, November, there is none. So all this means is that the data we're looking at right here is just from, this is backwards looking, but we're looking at as at September versus June. So when there's a difference between the two numbers, like right here, from 1.0 to 2.1, that's like really off. That's off by more than 100%. Yep. So he seems confused too, and it's probably still even too low. Why? We just printed 4.9, baby. It means that number is probably too low. He's going to have to revise it again. And this has been revised, right? The GDP for 2024. When we look at the unemployment rate, there's revisions here too on all of them, from 4.1 to 3.8, 4.5, 4.1, 4.5 to 4.1. Well, that looks really stubborn. We're currently at 3.8. That seems like we're just going to level off. And now we got to look at PCE. Well, these numbers seem off too. We're currently at 3.8, and it's currently October of 2023. We're not at 3.3 average. That's wrong. So he's wrong on most of his numbers here. So when we look at the Fed funds rate here, well, here they're saying, no problem here, sir, right? 5.6 this year. That's the same as our June projection. That's their higher for longer narrative. And they've actually increased their 2024 and 2025 numbers. But none of these are currently projected correctly or revised correctly. So I don't think they know what the hell they're talking about. Why? That's because the saying is the Fed keeps hiking until something breaks. And when the time something breaks, most declines happen in a bear market, right? Most declines after pivot. Let me see if I can find that really fast. And this is important because when we look to the numbers, like we have to understand what we're trying to understand from them. What does it tell us? And for me, what this means is that when we think about the Fed's balance sheet, here, I got the graphic here. So let's look at this really fast because the Fed's not going to tell you recession's coming, right? They're just going to break something. Happens every time. We looked at data starting this video that goes all the way back to the 1970s and 80s. Well, look, if the Fed pivots, if they cut interest rates, man, that's confirmation, right? Pause is supposed to be bullish. Pivot is bearish. Pivot's when they break something. So they pivot in 1969, 73, 81, 2000, 2007, and 2019 and 2023, maybe 2024. We declined by 36, 48, negative 27, negative 50, 51, 58, or 35. And as I just told you, the S&P is currently only down by 14, 15%. So let me see if I can find the stat there again really fast. When I look here to what is currently happening, man, would you like to get a warning when the S&P, we were currently down by, let's go 427 divided by 480. We were down by roughly 11%. We're in correction territory. When I admitted I was wrong, now the S&P is down by 14. But this means an additional 36% decline, an additional 48% decline, an additional 27. That's not the total drawdown. The total drawdown is like that's like 50. That's like 60. So that's only the decline after the pivot. There's actually even a larger decline. And the Fed's probably not going to pivot for a while. So they're willing to break something. So let's look at a few more data points to understand what they're breaking. GDP now is strong. So yeah, but now it's pointing down. And with that artificial government money rolling off, that could get us down to negative because we're looking at quarter over quarter. Oh, I forgot how these things are calculated. And then the other part is that who's buying, right? So China sells most US securities in 4 years. They sold a lot of stonks, they sold a lot of treasuries. Why? Because they want to, and because they don't want to support America. So there's outflows. China's selling, the Fed is selling. Why? Look at the balance sheet. So going all the way back here to, let's just refresh. So they massively pump it up, and then we can look here and see that there's a low, low, higher low, higher low, and then something similar here happens in about 2013-ish, where they blow the balance sheet up again. Then we get down to about 2.8. They increase again, just like they did here. So they reduce the balance sheet. Dead can't bounce because something happens, right? They temporarily stop, and then we go to 2.8, 2.8 again. So the low here is 2.82. Then we get 2.80, double bottom, boom, balance sheet explodes again. That's when the stock market goes up. Massive expansion. There's the first runoff, and now we actually have a lower low. We did not do that in 2010. So if things are already really bad, like, oh my God, the national debt is incredibly high. This is from usdebtclock.org. And we know that interest rates are as high as they were in 2000 and roughly the 1990s. And we were making we were 3 times less in debt. So it was 3 times less bad. And now we're actually even getting even more selling from the Fed, a guaranteed buyer. Japan is lifting off from interest rates. So we're doing something we didn't even do in 2010 because we're forming a lower low. And it's like a sharp decline. If we zoom in here, it's like, whoa, right? Whoop, dead cat bounce. That's SVB, by the way. Silicon Valley Bank. We were at 8.3 low. We go up to 8.7, and now we're even lower. We're at 7.9. That's called balance sheet runoff. Whoa. Okay. Does that explain why interest rates are so high? Yes, the Fed funds is at 5.3, but the 10-year note has been climbing dramatically higher. Why? There's a few things. $7.6 trillion of US government debt will mature in the next year, adding pressure on rates, which means if these numbers are true and the Fed likely pauses for a year, what does that mean? In the next 12 months, $7.6 trillion in interest-bearing US debt will mature. There's so much supply, and the Fed is not, there's no relief. There's no buyers. The marginal buyers, what they call that? Well, it's not going to be China, right? They're selling, they're not buying. Banks are underwater. Retail, everyone's underwater because bonds are up, which means that what you bought, you have an unrealized loss. Hundreds of billions, if not trillions, for banks. The Fed is selling. Japan is not buying anymore. China's not buying. Who's going to buy? I don't know. And they got to sell $7.6 trillion worth just in the next 12 months. And then they're also surprising to sell more. What's happening in the Middle East, another 100 billion. What's happening in Ukraine, more. So this represents 31% of all outstanding US debt. It's still below 2020, but we're issuing at 5% interest. So unless we're getting GDP at 5% over whatever the maturity is, 2 years, 4 years, we got an auction here. I'm looking at an auction happening on the 30th of October, which I believe is going to be on Monday. That'll be really important. I'm not sure what the auction is amount. Is it 2 year? I don't know, right? I'm not a bond expert, a treasury expert. The auction date between 10:30 and 11 a.m. Government debt will auction treasury bills in a series. So the reason why this matters is because we want to know whether or not the government is going to surprise by issuing more with what they need to fund the government, to fund what's happening in the Middle East. You saw the headlines I showed you earlier, right? You're gonna have to spend some money now, of course. So if they issue more, then that means that the 10-year note goes even higher. And if it keeps going even higher, that adds even more pressure to stocks. Maybe we get uninverted. And right now, this is like a rocket ship. It's mooning, right? Golden cross, fresh highs. Man, I wish this was the S&P 500. Straight line higher, 4.8. Man, that's a strong charge, right? Bullish crossover or a golden cross, and we're just bouncing off the averages here. It looks so strong. And that inversion chart that I showed you earlier is what we don't want to see. The uninversion usually means we're closer to the end than not. We're below the area we were in 2019. We're back in an area we were back in 2007 and 2000. Those were not good times. Those were not good times for stocks. Let's go to SPX and see what happened. Let's go to a log scale so we can actually see it a little bit easier. And now let's zoom in because we showed you the declines after the Fed pivot. But if we're currently only down by 14, it means we're currently about right here, right? So we're currently about right here. There's the all-time high. We're currently about right here. Would it be nice to hear a warning when we're about right here instead of like being, oh my God, now we're down here and I wish I would have known before. And I hope I'm wrong. I hope this doesn't happen. But the evidence is telling me that the case for the bears is building. So if the case keeps building, I better be careful of that. The total drawdown or total loss here is like 50%. It's 50. Okay. So we're currently only about right here, and the potential decline is this much bigger, right? This box seems a lot bigger than the top one. Okay. So as we keep entering correction territory, re-enter bear market at -20, those are the numbers we want to keep in mind. -20 is like a lot lower than -10, though. That's twice as low. And it's a lot easier to stomach losses when you're down in the double digits. How do I know? From experience. Let's go back to 2008. All right, there's our high. What was the total drawdown? From peak to trough or from high to low, we're looking at roughly 57%. Okay, so where's our -15? 14, 15, which is where we are right now on SPY. -14. We're about right here. So, right, all the way down, dead cat bounce from some kind of head and shoulders. Right, shoulder, head, shoulder. Okay, and then right here at -14. Well, man, that's like, whoa. So what was the pattern? Monthly lower lows and monthly lower highs closing below the previous candle low. Yes. As the selling accelerated, right? We're closing below the low every time, until we get closer to the bottom. Same thing happened over here. We close below the low, then we close below the lows. Selling continues. Same thing right here as we're accelerating to the downside for the nastiest cuts of the bear market. Well, let's be mindful if it keeps happening. Like, what do we have here? Oh, crap. Lower highs, lower lows. And for the last 2 months, what are we? Below the previous candle low. Below the previous candle low. We got 2 sessions left. Man, bulls better show up. And it doesn't matter if we're oversold. We can get more oversold. So hopefully now you're understanding what I'm looking at as it relates to the Fed, because it's not just the Fed, it's also the US government. And Joe Biden just right? Man, Jerome stopped printing, but Joe was right there. He's like, time to print treasuries. They didn't do a good job of locking in that low rate like a lot of people did on their mortgages. And we can also note here and see that a $2 trillion corporate debt wall will spark job losses in 2024. So this other headline here, 7.6 trillion of US government debt will mature in the next year. And also another 2 from corporations. That's just 2 agencies. So let me do some basic math here. 7.6 plus 2. Okay, that's like a lot. That's almost 10 trillion. Why does this matter? How big is the biggest company in the world? Let's have a look. Let's look at the heat map. It's Apple. They're worth about maybe 3 trillion. How big? 2.6. Okay, so we need to get to. So $9.7 trillion is going to mature from the U.S. government and just from corporations in the next 12 months. Apple is worth 2.6. Okay, we need to go find another 7.1 trillion just to understand how big this is. Okay, how big is Microsoft? Second biggest, 2.45. Okay, so let's go to our calc. All right, minus 2.45. Okay, only need to find 4.6 billion more, right? That's couch change, so we can easily find that. I think Google's the next biggest one, 1.5. Okay, minus 1.5. Need 3 trillion more, please. All right, add an Amazon. That's 1.3. All right, minus 1.3. Still need a 1.8 trillion. All right, who next? NVIDIA. All right, NVIDIA is a cool exact 1 trillion. All right, minus 1. All right, still need 800 billion. All right, who's the next biggest company? I think that's Meta. Yep, where's Tesla? Tesla is a bit smaller now, I think. Tesla's worth 650 billion. Sorry, Tesla, you don't meet the criteria. 760 for Meta. All right, minus 0.76. Boom. All right, that's been paid. What did it take? We have to sell the equivalent of the entire Apple, the largest company ever in the S&P 500 and currently the biggest. We got to sell the equivalent of an Apple, a Microsoft, a Google, an Amazon, an NVIDIA, and a Meta. That's the 6 biggest stonks in the market all at once, all in the next 12 months. That seems like a problem. So 7.6 plus 2, that's why rates are going higher. And that means the government's going to have to pay it off later when there's probably what? Less growth. So if we go to the GDP now, over time, do we average 5%? Nope. 3.4, 2.7, 2.8, 2% is like considered like good. Anything over 2 is like really good. So if we're selling debt at 5, how the hell are we ever going to pay that back? especially when we have this problem, a debt problem, right? This is called the long-term debt cycle, which is what Ray Dalio keeps being so concerned about. Just pause the video, look at these numbers, and ask yourself whether or not these are realistic to pay back in real nominal dollars, which means in real money. Could we pay back $33.6 trillion in national debt? That's just national. It's not state debt. It's not municipal debt. That's just federal. So, all right, that's equal to $100,000 per person, kid, old, right? Young, old, doesn't matter. And $259,000 per taxpayer. I don't think that's ever getting paid back in real numbers, real nominal wages. Sorry, real nominal dollars, which means they got to make it worth less. They got to inflate more. We need more inflation. That's what I don't think people really understand. And then here, that credit card example, well, the Visa's maxed out. And now people are saying, I'm not going to raise your limit. When you only owed 34%, I could increase your limit. When you owe 55, hey, I'll increase your limit by less. And now it's not. And the part that's really concerning as well is that the largest budget items, including what people call what's the word right now? I forget. Entitlements, your Medicare, Medicaid, and Social Security. That's about $3 trillion. But the concern here is that defense is at 825, and interest rate is actually going to become a larger amount than defense in the next 12 months with all that issuance. So when you spend more money on your Visa than you do on weapons, that seems like a problem too. So a lot of things are compounding at a macro. So fundamentals are one thing, technicals are another, but the macro is what really matters for me, the macro environment. All right, now let's round the story out with Apple. And I know there's a lot of information in this video. Hopefully you're getting a lot of value. And again, I would really consider if you could just subscribe to the channel, or please drop me a comment, because I put a lot of effort into this video, and hopefully you're enjoying it. All right, Apple, the king, what's going to happen? Earnings come out on the 2nd of November, or on Thursday at 4:30 p.m. And we're expecting a beat. So 145 over 139 would be good. We already talked about how Apple is reasonably priced. Currently, it is overpriced. It's currently priced at 28.31 for Microsoft. For Apple, it's at 25. I think what's going to matter for Apple is going to be whether or not they mention anything about a car. That would be pretty cool, right? One more thing. I don't think they're going to do that. It's usually a WWDC. And they announced their big headset. So that headset they announced, if they're actually going to sell those, it's $3,000 a pop. That's like pretty expensive. That's 3 iPhones. I don't know if people are going to buy those. I'm interested in buying one. I just don't see the utility yet. It's like the watch. At first, the early adopters. Let me see if I can find this. The bell curve of adoption. Because what Apple is really good at is getting people to actually adopt. So when we think about here, when we think about the iPhone, let me see if I find another example, because there's one with BlackBerry and stuff in it where some people still use BlackBerry. I'm sure they do. All right, doesn't really matter. I'll just use this one here. So on the bell curve of adoption, numbers might be a little bit too big, so I'll just zoom out. It's 2.5% are innovators, 12.5% are early adopters, 34% are early majority, 34% are late majority, and laggards are 16%. So what we're trying to find out is where Apple is in its cycle. So same thing like with Tesla, right? What was the first one? The Roadster. Then we had the Model S, right? 100 grand. So we get to here. Then we get to like the Model T, Model X or Y, whatever, Model 3. And now a lot of people got Teslas. We're probably going somewhere over here for Tesla. Same thing with Apple. Everyone has Apple now, right? We're all the way here to the laggards, having a hard time selling phones, but I'm sorry, they sell a whole lot of phones. Let's be honest, it's most of their sales. But in terms of the new device, we're gonna have a few people innovate. And if Apple starts telling us that sales are good, it means we're gonna get a nice a cycle for the VR set. Meta did some R&D, research and development, but now Apple's gonna make a better version of it. So if we're here, we're starting to kick off early adopters. Like, I'm not an innovator for this device, just like I wasn't for the watch. I like Apple, I like the watch, but what I said is, I am not willing to buy the watch unless it can independently make a phone call, which meant I don't need to have my phone with me. If it's tethered to my phone, I need to have my phone. What I wanted was my watch tethered to a Bluetooth, so that way I can make phone calls while I'm away. I can actually leave my phone at home. Until then, I didn't want the watch. I believe that was Apple Watch 3. Maybe it was 2. I can't remember. But then I've bought 2 watches since then. So Apple has made money from me. In terms of the VR set, I'm not willing to pay $3,000 for it right now when I don't really see the utility. So I'm not an innovator, just like I wasn't with the watch, but I will buy one probably as an early adopter. when I can see a few more use cases for it, and maybe the price drops a little bit more. So that's what I'm looking at for Apple. I don't think they'll talk about the car, but that would be like a big wow. I think they'd rather do it right than do it fast. So I think the best shot for Apple is going to be their VR set. But right now, they largely depend on on iPhone sales that happen in like China. And Tim Cook just flew there. You don't usually go there when business is good. You go there to round up business, right? Drum it up. So I think maybe sales might be a little bit soft there. And they've said that you can't actually buy the Chinese government said government officials are not able to buy the Apple iPhone anymore, Huawei only. Well, that seems like a problem. That's our second biggest market. So yeah, earnings are going to beat. What's the guidance, right? What have you done for me lately? Is your forward PE actually going to be 25? Or if you tell me that actually sales are going to be worse tomorrow than they are today, this number is going to go up. So if Apple's already at the high end of a rich valuation, meaning 25 to 30, if they say the future tomorrow might not be as good, well, they could become a Google, where Google is now at 18, Meta's at 17 for their forward PE. Apple is still richer than it. By how much? Well, 26 divided by 18.5. It means that Apple is currently roughly on a forward PE 40% more expensive than Google and more than 40% more expensive than Meta. Why? Because the PE is a lot lower. It's not as dark, right? It's closer here to 15 to 20, which means fair valuation. So it's still gone up 13% in the last 12 months. That's good, but it's not a Microsoft. Even Google's doing better. Why? Because it's fairly priced now. So anyways, there's a lot of stuff we just went through. Hopefully you at least understood a sliver of it. And what this comes down to are like a couple of really big high time frame charts that I think are going to really drive the story here. Let's go to the other chart that I had here. Excuse me. Let's go back to arithmetic and let's go here to the Russell IWM. So when we look at a lot of these other charts here, the Russells is one, and we already looked at RSP. So hopefully you caught that part. If not, you can rewind the video. Looking to here, this is bad. On the monthly chart, we're below the 2018 and 2020 highs. We're 30 some percent off the highs, like 34%. We're currently 34% off the highs. We're below the 2018 and the 2020 highs. We've lost all support on the weekly. We're blowing out the low, right? Tap, tap, tap. Eventually, that doesn't end up being support, and we go lower. That's how we can form another what? Another M for more downside to revisit the lows. Okay, that's a little depressing. Yep, I'm sorry. Not intentional. We talked about gold and Bitcoin and dollar all being up on the month. Well, what's not up on the month? Well, S&P and the NASDAQ. Let's spend a few minutes on those. So S&P actually just lost its 410.64 low from February, or the potential for an inverse head and shoulders to start on the monthly here. So if we keep going below, that's not really a shoulder. That's not a bullish pattern. And arguably, we'd rather see the wicks happening here because it means that's where the dip buying happens. The real bodies are higher, which means last month when I was still bullish is when it looked a little bit more like there was potential for us to carve out a sideways, at least inside bar before going higher. We can still go up. The battle is just harder because this pattern is not as bullish as the other one I just showed. They're still over the average, but I just laid out a template how we could actually lose 400 and we can get down to 370, which would be below this average. And what happens when we go below? Oh no, it's 2000 or 2008. Yeah, neither one of those times was good. So we looked at the weekly, we looked at the dailies. Well, yep. Once we start getting below that 50 monthly, the good things don't happen below that. Nothing good happens below. So, All right, then QQQ, because, and then looking at the weekly, we've stopped going up. We're definitely back to going down. So if we're not going up and we're going down and we're below the short-term price, we could probably slam down to 393, which would be that 200 weekly, just like RSP did, right? From the 50 right to the 200, and now we're even below. Last one to look at here is going to be QQQ. All right, so the Qs, what are they telling us? And like I said, I went through probably like 30 to 50 charts. So if you want to look at more, follow me on Twitter. And I would really like it if you guys could go comment on a few of those posts. I'd like some engagement, please, and thank you. QQQ, it's not really a trend because we lost it. We're not pointing up. We're probably pointing down with some kind of sloppy pattern here. I'm not quite sure exactly what this is. Do we adjust it to mean we use these lows? We could. I don't want to tell the chart what it's doing. I'm trying to just be receptive to what I'm seeing. And right now I'm seeing we're not going up anymore, even though we're above averages. And we're kind of stuck here between the relative highs. The S&P has already lost this area. It's 432 equivalent. If we fall back below 298, we're already going to be another 50 points lower. And that means we're probably going to go to 300 here. All right. Very, very long video. Thank you for tuning in all the way until the end. This should be a roadmap for not only the rest of the month, but for the rest of the year and maybe even beyond. If you want to see what we talked about last weekend, where we said the stage was set, I would encourage you to watch that video now, queuing up in a moment on the left-hand side. But if you want to come trade with me, Justin from YouTube, you can go to our website, thealgo.com, to trade for 14 free days with me and see exactly how we take all of these notes to formulate a plan and try to beat the market. Thank you so much for tuning in. I look forward to seeing you on the next video. Thank you.